Hello, everyone. Welcome to video 6, I believe this is, of chapter 9. In this video, we're going to start talking about non-arm's length transactions. So if you keep someone at arm's length, the insinuation is that they are a third party. They're someone you don't know. You keep your arm out, they're always a fair distance away. It means that your relationship with this individual isn't personal. Why is arm's length transaction important? The issue is if I had something I wanted to sell and I go out into the market, I want to sell that thing for as much as I possibly can. The person in the market who wants to buy it for the least amount of money they possibly can. So the assumption is if me and them come to an agreement on a price, then that price is in some way fair. It satisfies my desire to sell it as high as I can and satisfies their desire for as low as they can. So that price is the middle ground where both parties find the transaction acceptable and are happy. But once you deal with family members or people you're very close to, your motivation might no longer be to get the best, dollar out of the transaction. Your incentive within a family unit or for people who are very close to you might be to share assets and money and to do so in a way that saves you taxes. So because the tax transaction, the tax consideration becomes a higher priority, the CRA and the Tax Act looks at these transactions with greater scrutiny. So let's go into the lecture and try and sort of sort out the rules around non-arm's length transactions. So, as I mentioned, when property is sold in transaction between any persons, the assumption is that the price reflects its fair market value. I've agreed to the highest price, they've agreed to their lowest price, so the price must reflect a fair price. It's a fair market value for the thing I'm trying to sell. The key feature of the fair market value is parties to transaction are acting at arm's length. Arm's length refers to an agreement made between two parties freely and independently of each other without some special relationship control or influence. The transaction price is susceptible to manipulation with the purpose of reducing income tax once someone's selling property to family members, especially if they're selling it for below fair market value. If I took this thing to the market, I could sell it for $30,000, but you're my brother or cousin or uncle. I'm going to give you a break on it. I'll sell it to you for 20. So what does that mean from a tax perspective? Related persons are deemed not to deal with each other at arm's length, so there's no need to examine particulars of transaction to determine if there's arm's length bargaining. So individuals include family members, not necessarily cousins, nieces and nephews, uncles and aunts. The rules around non-arm's length transaction look at immediate family. So they look at siblings, parents, children, grandparents, grandchildren. So it looks at that immediate familial environment. But that's not to say that cousins, nieces, and nephews and aunts can't be non-arm's length transactions. It just means that they're not immediately default to be considered non-arm's length. If you trade with your family, it is your immediate family, it's a non-arm's length transaction. If you trade with someone who's slightly outside that circle, they are not they're not necessarily non-arm's length, but there is an argument to be made. It doesn't even have to be family. It could be my best friend. My best friend and I, we have a close relationship. They're like family to me. So I might be incentivized to deal with them in a non-arm's length situation. Um, Dealing with family member and also any personal trusts that where the family member's the beneficiary is also non-arm's length. A factual non-arm's length test is a question of fact whether persons are dealing with each other at arm's length. The rules allow the CRA to challenge transactions between persons who are not related. So questions of fact being, do you have a pre-existing and especially close relationship? How much time do you spend with each other? How long have you known each other? How intertwined are your lives? So these questions of fact allow my best friend, who's not a familial connection, to still be considered a non-arm's length individual. So common indicators of factual non-arm's length include common mind setting and dictating terms of transaction for both parties, whether the parties are acting in concert without true separate interests, and de facto control where one party has effective control or significant influence over the other. So what they're saying is, do I have the ability to affect their decision? When I meet a stranger in the market, I say, here, I'm going to sell you, for $30,000. They say, that's a great price. And I say, actually, it would really be great for me if you could sell it, if you could buy it for $40,000. The other person isn't going to give me $10,000 just because they have no relationship with me. So if I have the ability to dictate unfair terms of the transaction, then there must be a relationship between the parties beyond the financial. If parties are acting in concert, which means if we arrange the transaction in a specific way, is there a benefit to one or both of us outside of the economic transaction? And de facto control is, even though I've put the car in my brother's name, do I still drive the car? The transaction's taken place, money's been exchanged, but control over the asset hasn't moved. I can still influence or make decisions on it. So we're trying to see how much control do the parties have over influencing each other, and does the ownership truly change? The name might change, but has my ability to access and use the asset really changed? So we're going to talk about a couple things. I'm going to start with inadequate considerations, meaning you didn't pay as much as you should have for the asset, or maybe you got more than you should have for what you paid. So inadequate considerations between two parties. In the next video, I'll go into the rollovers and depreciable property. So in this video, I'm hoping that I'll cover inadequate considerations, we'll stop it, and then keep going in the next video. So what is an inadequate consideration? The problem comes in when the sales price, which should reflect the fair market value of the property being sold, establishes the proceeds and tax cost of the property to the purchaser. So what that means is, because in the market we expect that people will exchange things at a fair price, we often consider whatever money's being exchanged to equal the fair market value. That transaction freely made is the measure of a fair market value. If I could get more money for it, I'd go to someone else. If they can buy it for less money, they'll go to someone else. For us to have come to an agreement, we, members in market, must have agreed that it's a fair price. So the exchange principle is consistently applied throughout the Tax Act to basically say, when property is sold, whatever was paid for it, the proceeds, equals the fair market value of the asset being exchanged. So when someone buys the asset for those proceeds, since proceeds equal the fair market value, the cost of that asset moves over to the other person at the proceeds. So if I bought something for 50,000, sold it for 30, the person who purchased it for 30, that's their now new cost base when considering capital gains and losses in CCA. So a father with a marginal income tax rate of 29% sells investments with a fair market value of $200,000 to the son for an amount equal to his cost. My shares are worth $200,000, but if I sell them for 200,000, I have a capital gain of $50,000. So I say, well, what if I sell them to my son who has no income? If the father sold the property for fair market value at 200,000, he would have paid federal income taxes of 7,250. This is based on the capital gain at 29%. Instead, son will include a $25,000 taxable capital gain The capital gain in this transaction is 50,000, so taxable is half of that. So the $25,000 taxable capital gain will now be taxed at the lowest marginal rate of 15%. So I've been able to move that capital gain, that income from my tax bracket to a lower tax bracket by having my son sell it for me. By putting the son as the intermediary, now we've sold the asset for 200,000. The same amount of money is within our family unit, but as a whole, we've paid less taxes. So there must have been a valid disposition of property from father to son, meaning to make a valid transaction, basically the son needs to have paid me the fair market value. So if transactions occur at fair market value, the 200,000, then there's not really any concern. The issue is if I sell it to a family member, sell it to my son at my cost, and it does not equal fair market value. I've given them a discount. If the son is not permitted to do anything he wants with the property, but is obliged to sell the property, it could be argued that he never actually acquired it. My son never had control of the shares. I sold it to him specifically so he could complete a transaction with a third party. I maintained control. I dictated the terms of the agreement, being I'm going to sell it to you at cost so you can sell it at fair market value. So these factors are not assuming, they're coming to the conclusion that the transaction was inadequate. The beneficial ownership was not acquired by the son, so no disposition took place. So even though my son ended up selling the shares for $200,000, it's going to be considered that I sold the shares for 200. So that capital gain is going to come back to my income and is going to be taxed in my hands because the government feels that's where the gain should have occurred. Having the son involved didn't change the transaction. It just tried to put a tax saving intermediary. So when we manipulate the proceeds of disposition to transfer income in an advantageous manner, there's two main situations. We can give something as a donation or a gift where we get nothing in return. Or we sell with a non-arm's length transaction where consideration paid is less than or greater than the fair market value of property sold. If we sold it at fair market value, if my son bought my shares for $200,000, I'm going to report the same capital gain than if a third party person bought it for $200,000. So there's no tax advantage. That is a fair market transaction. The concern only comes in when we're exchanging those shares for proceeds that don't equal the fair market value. There can be, if we fill out a contract, we can put in a price adjustment clause, meaning we say we did what we could to find the fair market value. We couldn't find a reliable source. We decided to exchange at this price. If the CRA disagrees with the price, we will adjust the proceeds to be more fair. It's a way to try and avoid the tax implication, saying we think this is worth $20,000, but if the CRA comes back and says no, it's actually worth 30, then my family member and I will exchange the proper funds to avoid inadequate consideration. So I want to focus first on fair market value and gifts and donations. The good part about fair market value is I've already mentioned that if we're exchanging things at the fair market, we are reporting gains and losses and various incomes as we would have if we traded with any other person. So there's not really a concern here. If we sell it at fair market value, the proceeds are fair market value, the person who bought it will bring it in at fair market value. If you give a donation, or you give a gift, you are deemed to have sold it at fair market value. So those shares that were worth $200,000, if I give them to my child, like, here you go, these shares are yours, I still have to report the shares and pay the taxes as if they were purchased at fair market value. If I donate the shares to a charity, I will say these were sold at 200,000. I will report that taxable capital gain of 25,000, but I'll get a donation receipt for the full value of the thing I gave up. I didn't get $200,000. The charity is enjoying that benefit of $200,000. So I will report the capital gain, but I will also get a charitable donation for the full amount. So anything that's given for no dollars is assumed and treated for taxes as if it was sold for fair market value. So both of these amounts are straightforward. If I sell for above or below fair market value, the proceeds for the transaction as the seller will always be assumed to be the higher number. The person who bought it will always have a cost base of the lower number. So it's no longer fair market value, fair market value. Now the seller is assumed to be getting the highest amount, the most money possible, and the buyer is bringing in a cost balance of the lower amount, the least money possible. And what this does is create a financial difference for taxes. Does it go into it? Yeah, we have an example here. A used car owned by an individual is donated to a local charity. The car is personal use property with a cost of $10,000 and a current fair market value of $1,500. So the car's worth $1,500, but it cost me $10,000 to buy. The car is deemed to be sold for $1,500. The charity is considered to be getting something that is worth $1,500. There's no tax implications because my personal vehicle, I cannot sell at a capital loss. So there's no tax implications. I won't report it as a loss, but I will get a donation credit for the $1,500. The charity acquires the car for $1,500. So that $1,500 is now the charity's cost base. So if the charity sells that car at auction for $3,000, the charity will report a capital gain for the difference. So the charity will report a gain on the amount because its cost was below. I will get a donation credit for the $1,500 of value I gave them. Example 2. So now we're going to look at transactions that are above or below fair market value. Starting with above, John Brown owns securities with a cost base of $200,000. There's a fair market value of $350,000. He sells them to his brother Sam for $500,000. The shares are only worth $350,000, but my brother bought it for $500,000. My brother is paying more for the shares than he ever would if he bought them from someone else. So my proceeds as the person selling is going to be the higher number. Since I've received $500,000, those are the proceeds. And the capital gain will be $300,000. My cost base of 200 under the difference between my cost base and the proceeds I've received. So capital gain, $300,000, taxable capital gain of half of that, $150,000. So big jump in my income. But Sam will have a cost base of the lower number between proceeds and fair market value. Although he spent 500,000, he only got something worth 350. That's his cost base. So if he does sell those shares for $500,000 down the line, he will also report a capital gain for that $150,000 difference. So if he sells for 500,000, he will report the capital gain for that $150,000 difference. So what this means is the amount over the fair market value is going to be taxed twice. I'm going to pay the taxes because I've reported the full proceeds of 500,000. Since Sam has the cost base of 350, if he sells for 500,000, then he will also report the gain. So that difference between proceeds and fair market value becomes an amount of money that's going to be taxed twice for both transactions. The Tax Act does this on purpose to encourage people to exchange items at fair market value. If the proceeds equal fair market value, I report the gain, or John Brown reports the gain up to 350. Sam reports the gain from 350 to 500. That change in value is only taxed once. As long as we keep it fair, those taxes are only once. If we want to play around with the proceeds and the cost base, The government says you can do it, but you're going to end up having some amount taxed twice. If we transfer for below fair market value, so now it's 200,000, fair market 350, now we sell for 300,000. My proceeds are always the higher number between fair market value and proceeds. So before I sold it at 500,000, the higher number, but now 350 is the higher number. So the proceeds are the fair market value. I report a capital gain on my full 350 minus 200. Sam has an ACB of the lower number, the $300,000 of what was actually paid, the proceeds. If Sam sells, there's a potential for double taxation on that $50,000, the difference between proceeds paid and fair market value. So this table above fair market value, if the proceeds are more than fair market value, seller reports proceeds. If proceeds are below fair market value, seller reports fair market value. So the seller is always going to report proceeds of the higher number, and the buyer's cost is always going to be the lower of those two numbers. All right, last one is a gift. I own securities of ACB, fair market value of 350. I give it to my brother Sam. The gift is considered to have been exchanged at fair market value. I report the capital gain. Sam has the ACB at fair market value 350. No double taxation. So if I want to give shares to my brother, I want the exchange to occur at a fair price, fair market value, or be a gift. The non-arm's length income inclusions is part of Tax Act Section 69. They are except as expressly otherwise provided in this act, which means these are the treatments of non-arm's length transactions unless specific rules are in place. And that's what we're going to get into in the next video, because exchanging items with your spouse or perhaps your child has slightly different rules. So this says the rules for spouses will override the rules for just general non-arm's length transactions. And for my children. So dealing with my children under 18 is treated a different way than dealing with my children over 18. Okay, let's get to the exercise for this one. Inadequate consideration, non-depreciable capital property. Mr. Carl Lipke owned land with a cost base of $100,000 and a fair market value of $25,000. He's lost money of $25,000. He sells the land to his brother for $95,000. So the brother's buying the land at more than it's worth. The brother immediately sells it for $75,000. Determine the income tax consequences to both Mr. Lipke and his brother. If we were to look at this as face value, the cost was $100,000, sold for $95,000. So Lipke has a capital loss of $5,000, and the brother would have a capital loss of another $20,000. When we go to the exercise, I've included the table here for reference, so you have something immediately in front of you when you're going through these transactions. But basically, we have three numbers: our cost base, the proceeds transferred at, and fair market value. But proceeds do not equal fair market value. So Carl will be deemed to have received the higher number between these two. So the higher number is 95. He received 95. So his capital gain loss will be $5,000. An allowable capital loss, half of that, 2,500. The brother experienced a $20,000 loss. He bought it for 95 and sold it for 75. He experienced a capital loss, but his cost base is going to be the lower of the two numbers. The proceeds of the sale are the higher, the new cost base is the lower. So the fair market value is 75. Brother brings it in at 75,000 as the cost value. So he immediately sold it for $75,000. So even though he lost $20,000 of money, of capital loss of $25,000 from money spent, from a tax perspective, he didn't lose anything. So Carl and his brother, because they did the transaction this way, have kind of missed out on $10,000 of allowable capital loss that could have saved them taxes in the future. So that is the consideration for non-arm's length transaction. If you exchange at fair market value or give gifts, it's very straightforward. Fair market value equals proceeds. Whatever you sold for comes over as the cost base. It's when we have prices not equal to fair market value that funny things start happening. Thank you for your time. When we come back, we're going to discuss transferring assets with specifically spouses and our children. Thank you.